Hello again. This is again our lecture for General Introduction to Tax Law, and this is part 3 or chapter 3, basics of the namely German income tax law, and the beginning is part 3.1, personal tax liability. So from this chapter onwards, we are going to concentrate a bit on matters of income tax. And the first thing which you probably want to get confronted with, if you have an income tax in mind, is a testing scheme or a way how you can deal with a case in a logical way so that in the end, irrespective of how complicated it might be, you get an overview of how that case will be correctly assessed under income tax. And so I just want to give you first a general testing scheme. It's relatively, no, it's not so, oh, looking for words is nearly as hard as looking for solutions in an exam. So this testing scheme is not very refined, but it is a robust testing scheme which you can use for every case which you come across. The first thing is always, when it comes to income tax, you need a person who is a taxpayer. And income is not possible without a person who has that income, and that is always the first step to identify the person behind the income, and then to decide which kind of tax liability is applied to that person, because there are two different kinds of tax liabilities in most countries of the world. The names for these two types of tax liability are usually differing from country to country, but in principle it's always the same basic structure. So personal tax liability is the first. And now if you have established the tax liability of the person and the rules applying to the case, then you naturally change over to the events, to the income, or to the tax object. So that second thing is the objective tax liability, or if that's too complicated for you, the analysis of the taxable income. And there you can think about a few sub-steps which you can check for every event. For example, the first thing, usually a tax law has several different categories of income, and usually it matters to which income type your event belongs. So the first testing step here would be, which type of income is that? Yeah? Again, the denomination type of income would be a German one. In England, they would talk about schedules. So, but in principle, you would have to find out to which category of income belongs your event, and so which rules apply to that specific case. Then the next thing is, how much is taxable? If you have the rules how a thing has to be assessed, then you can compute what you need. For example, under German income tax law, there are two different tax bases depending on which type of income you have. One is the profit and the other one is the surplus. And so you would decide, I need the profit or I need the surplus. Then you know what to calculate and can calculate it. And my standard question number 3 is now, after you found out what is taxable, there is also the time dimension. To which year does this event belong? Is it for the tax declaration of this year, of next year, or of the following year, or of the last year? So these 3 questions always can be answered with a few basic rules, and so you always can find out at least the first genuine overall impression on what happens in a case. Number 3, at the end, when you have checked everything through what happened during a given period of time, for example, what happened during 1 year, then the income tax is usually levied due to its progression rate character. The income tax is usually levied for a whole year. So everything what happened during the year and is taxable will probably be added up. In Germany, in the German system, you would first add up the results within every category, so within each type of income. And then you would add up the results of the different types. And from the overall result of that, your total income, you would then deduct those personal expenses, which you can deduct. And then in the end, when you have the total taxable income, you would then begin to calculate, to apply the tax tariff and calculate what has to be paid. The last entry in my testing scheme is a kind of a dummy. Are there special or particular or peculiar aspects connected with the case which have not been dealt with up to now? So there might be some questions which can only be answered at the end of a case when you know everything about it. And so this is just a kind of a reminder that one should also at the end of a case always make a short review. Have I overlooked something? Is there any aspect in the case which with my standard testing scheme I could not yet find out, and so on. So the first and important advice for you is keep that scheme in mind, because that is a good way to address every tax case. And personal tax liability is relatively simple, so you probably can always find a beginning where you can say something which is definitively true, and then work on with the case until you find real difficulties. But at least you can always have the good feeling that at the beginning you are absolutely right with the case. So in order to make that possible, one naturally has to think about the personal tax liability, naturally. And so the first idea what we should deal with is probably why are persons so important? And the answer is, let us have a look to what is income. Income is the increase of your property, however you measure that, but it's the increase of property. That's the basic idea of what income is, so that you get richer than before. Now, becoming richer than before requires that you have the ability to own something. Somebody who has no legal ability to be the owner of something cannot get richer. And that leads us directly to the civil law of most countries, or to your country. You will have to find out who can own things. And under German law, for example, only persons can have rights and obligations in the legal way. So your dog cannot own money. Your dog cannot own its frolic. All that belongs to a person, so to a human being. By the way, the dog also belongs to you, because legally the dog is not a person, but comparable to a thing. So only persons can own something. That means everything which is out there is owned by a person. And then only persons can get richer if the value of that property increases. So first step is logically only persons can have an income, because only persons can have property which can go up. So only persons can be taxed by income taxation. So the first step is always, when you see there's money around, somebody or money is paid, the first step will always be, who is made richer by that? To whom does this income belong? So look for the person behind the event. Good. Now, what you perhaps as a beginner not yet know is we have two types of persons. The denominations for these kinds of persons in the law literature are completely different depending on the states. In Germany, we would speak about natural persons and juridical persons. Alternatively, I found out that in English literature, the natural persons are far more often called physical persons or individuals, human beings. They are called natural persons in Germany because these persons exist in nature. They owe their existence to natural causes. On the other hand, the juridical persons are not really existing persons. They are fictions which have been established by law. So a GmbH, an AG or so are to be treated as if they were real persons, so as if somebody named Deutsche Bank AG really existed. So a fiction under the law. And as a consequence of that, this is a legal fiction, the law is binding. Everybody has to do as if there is a person out there which is called Deutsche Bank AG. So Deutsche Bank AG is treated like a person. It can buy a house, a building. It can employ people who work for it. Yeah? And it can take up credits, and so it can owe money to others. Yeah? But the trick, by the way, is that, for example, the shareholders of Deutsche Bank AG are different persons from Deutsche Bank AG. So all the liabilities of Deutsche Bank AG are not liabilities of the shareholders. And as there is a basic principle, every person is responsible for his or her own debts. Only this fictitious person, Deutsche Bank AG, would be liable with its property for its debts. That is sometimes because why one calls such a juridical person often a limited company, because the possibilities to approach the shareholders with claims are very, very much limited, or in theory, they most often do not exist at all, because the shareholders are different persons from that juridical person, and you had your contract made only with that juridical person. So we have two kinds of persons, the ones who exist in nature and the other ones who just exist by a fiction which has been given by law. Now one thing is clear, that these juridical persons or judicial persons or juristic persons or legal persons, however you call them, that these persons only exist by order of law. That makes it necessary that there are laws which say this, and this institution are to be treated as if they were a living person. So you and I cannot freely invent or create a juridical person. It's only possible if we use the mechanisms established by a law. And if then the state gives a binding order that now everybody has to do as if such a juridical person existed. Yeah? So you can not regard everything freely as a juridical person or not. There must be clear legal standards if such a thing is a juridical person or not. You can not only learn the types of juridical persons by heart, there is no other alternative. For example, in Germany, you would know that a GmbH, that is the German equivalent to a limited private limited company, that a GmbH has to be treated as a juridical person. This is in fiction a person. The same with an AG, the German abbreviation for stock corporation, Also, this has to be treated as if it were an independent person, different from the shareholders. So you do as if an AG is a living human being. Same with an EV, so that's private association for non-economic motives. A chess club would be an EV, could be an EV. A football club is often organized as an EV, which a bit ignores that football is big business in the meantime. But very often they are organized as an EV. Then also naturally other countries also have the institution of legal companies, legal persons or juridical persons. So one also has to be familiar with the usual abbreviations which signal to others that you have to do with a juridical person. For example, behind the name of an English or Irish firm, the abbreviation LTD would signal this is a limited company, so a juridical person, or the abbreviation Corp for corporation or Inc for incorporated would also signalize to you this is a juridical person. Good. Yeah. Now, in principle, we want to tax income in the hands of the person who or which owns that income. And I have laid out to you last time that, for example, with natural persons, the net or subjective net income principle plays a big role. You can only regard as a tax base that amount which the taxpayer does not need for survival. You will have to grant personal deductions for the money needed to feed and keep alive children, or you will have to take into account if the taxpayer is married, because then the taxpayer's ability to pay is a bit different, has to be judged differently. Now, all these personal aspects do not exist in case of a juridical person. A juridical person does not need to eat and drink, so there is no basic allowance necessary. A juridical person does not have children, which have to be supported, and so on. And so there are some differences which justify that perhaps the income tax rules for juridical persons are a bit modified. In order to make that clear, to have clear standards what applies to natural and juridical persons, very often states differentiate between the income tax law for natural persons and juridical persons. In Germany, there is, I think, a very clear distinction. Germany just says natural persons are subjected to the Income Tax Act, and juridical persons are subjected to a special tax act, the Corporation Tax Act, which is usually similar, but which is different in all the aspects which cannot apply to a corporation, or which regulate those phenomena which can only appear in the case of a corporation. Other states usually have a similar distinction. So the first thing which naturally you have to decide when you deal with the cases, does the case fall into the scope of income tax, or is it a corporation tax case? And for this, you remember probably the first entry in my list. Is the person in question a natural or a juridical person? Because that question helps you to decide if it's income tax case or if it's a case for corporation tax. Now, I don't want to hide from you that there is another potential combination possible. It might be that income is achieved by something which is called a partnership. Now, a partnership is defined as several persons associating together with a common aim. So, a partnership is not a juridical person, but it is several persons acting together. And so if a partnership buys a house and then lets that house for rent, then the rent is achieved by the partners together, because partnership is common activity of several persons together. In that case, the solution will often be that tax law says, okay, in such a partnership, when the partners act together, a certain amount of the money which has been earned together is owned by each individual partner. And so, according to that, in a partnership, usually the taxation is made differently, separately for each individual partner. Everyone has to pay income tax or corporation tax on his, her, or its share from the partnership income. Good. So we can sum up. The first step in testing scheme number one is which person owns the income. You have to find out if it's a natural person, a juridical person, or is it a partnership, and that dictates the next steps which you have to take. Just a note, the German distinction is strictly according to the lines of who is a natural or juridical person. Some other states sometimes have the idea the income tax legislation that is the general rule, and then they define some special area for corporations. Some special taxpayers, mostly juridical persons, are then taxed under corporation tax. For example, in the UK, corporation tax only applies to juridical persons who are or which are situated in the UK, and to a so-called permanent establishment, so a shop, a bureau, an office of juridical persons which are established somewhere else. If a juridical person, for example, from Germany obtains simply money from the UK, then that would not be covered under the corporation tax. But then the income tax law of UK would again apply, because corporation tax for them is the special rule, and special rules apply in the special cases. And whenever a special rule does not apply, the general rule comes back and says, hello, here I am again. I am the British Income Tax Act, and I am valid or applicable for every person, as long as not a special rule takes over. And so the line between the two kinds of laws can be different in different countries. So when you work yourself into the basics of foreign law, the first glance should always be, is the distinction, the line between income tax and corporation tax there in this foreign country is the same as in Germany, or is it rather the British approach? So you will have a close look in what is covered by income tax and what is covered by corporation tax, and how's the relation between them. So you cannot automatically trust with 200 different countries and cultures in the world that all have the same lines drawn between the two kinds of taxes, like the Germans. That seems to be clear to me. But very often you will find this is the line. Good. Now let's again concentrate on what can be a juridical person. I told you already, you can only learn by heart what is accepted as a juridical person. And there is one thing in the company law of most countries, that to facilitate to you and me that one finds out that something is a juridical person, in most cases a juridical person is forced by law to add an abbreviation signaling its legal form to the persons with whom it has to do. So in Germany, a limited company under German law, a GmbH, has to carry the abbreviation GmbH or another part of the name which clearly shows to you that it is a Gesellschaft mit beschränkter Haftung, that it is a limited company. If you have to do with an AG, a stock corporation under German law, also this has to carry either the name Aktiengesellschaft as part of the name or the letters AG as official abbreviation at the end or in the middle of the name. Yeah? The same applies to some other legal forms, for example, UG, Unternehmergesellschaft, which is a simplified form of a GmbH with less share capital, a cooperative society, so a society which has been founded primarily in the interest of its members, that is abbreviated EG, eingetragene Genossenschaft, eingetragen is registered, or we have already mentioned the EV, the Registered Private Association for Non-Economic Purposes. There are also under German law accepted an SE, so European Society. SE is the Latin abbreviation because as we have 27 member states in the EU said we need a uniform abbreviation. We should not prefer the language of any member state, and so we turn to Latin and translate the word into Latin and then base the abbreviation on the Latin expression. That, by the way, is a trick which they stole from the Swiss Confederation, who deals with the same problem in the same way for a very long time already, because if you ever watch the Swiss abbreviation on their cars, CH, this is Confederatio Helvetica, well, the Latin word and the Latin abbreviation, which also guarantees that none of the 4 languages spoken in Switzerland is preferred. Good. So the same applies to the European Cooperative Society, Societas Cooperativa Europaea SCE, also a legal form under European law, which can be founded in Germany. Now, all these juridical persons exist because a law says everyone has to do as if this entity is a living person. Now the problem is that naturally every legislator, every state can only issue laws which are binding on its own territory. So the US parliaments cannot order the Germans to believe something. They can try, but they will have no success. On the other hand, Germany, if the Germans say everyone has to do as if this entity is a person, a GmbH, well, this order is binding on the German state territory, but an American will shrug shoulders and say, what are German orders for me? Nothing. I'm not obliged to follow them. So in cross-border relations, there will be the problem. What happens when it comes to juridical persons of other states? For example, Microsoft Corporation is, as you see from the name, a corporation. So a corporation is, under US law, a juridical person. So everybody has to do in America as if Microsoft Corporation is a living person different from its shareholders. So Microsoft Corporation is somebody else than from Bill Gates, separate from Bill Gates. Now, if you come to Germany, a German would probably say, oh, what importance have American laws for me? Why should I think that Microsoft Corporation is a juridical person? I think it's Bill Gates and some 10,000 others acting together. But this would be a bit inconvenient. So most states say we decide to accept the decision of other states. We usually accept if a foreign state says something is a juridical person, then we usually take over that decision and accepted by our own will. So the German Bundestag would probably say, or German law experts, okay, under normal conditions, if the Americans say Microsoft Corporation is a person, then we are going to follow that decision and regard that entity called Microsoft Corporation as a living person. But you must clearly see, in theory, that is something which Germany can independently decide. We could also say, no, we just say Microsoft Corporation does not exist as a person, so we look through and say all the shareholders are just acting together. This is treated as a partnership. Usually we don't do that. The most common approach is the states usually accept the decision of other states. There is only one red line. For example, if a state has the idea that the foundation, the establishment of a foreign company is a kind of an abuse. So if they think it's not morally justified to accept the existence of that foreign company. For example, imagine you are a German and you intend to set up a shop in Germany. Now, to establish a GmbH for a long, long time, you needed a minimum capital of 25,000. Now, there are other states in the world where you can set up a juridical person with far less capital. So you could have come to the idea, I set up a juridical person with a capital of 100 euro in Farawaystan, according to the laws of Farawaystan, and then this Farawaystani GmbH opens a copy shop in the middle of Germany. And you are German, your business activity is entirely within Germany, and the only connection with Farawaystan is the registration of that company on paper somewhere in a file in Farawaystan. Then company law experts would say this is not justified, there is no genuine connection to that other state. Such a company should not exist. It should be founded under German law because it only is connected with Germany. There is no genuine link to the foreign state. So very often states say, in 99% of all cases, we accept the existence of foreign companies if they are genuinely connected with that foreign state. There are different approaches for that. Some states make it plain and simple and say every juridical person which is registered in a foreign state, so which got the status of a juridical person by a foreign state, is accepted by us as a juridical person as long as it is accepted as juridical person by its foundation state. So until it is removed from the register. And states like Germany, who want to prevent abusive behavior, say we accept the existence of every foreign company if the major connection economically exists to that foreign state. So especially if the place of management or the headquarters of that society exist in that foreign state. So the German idea would be where that company is genuinely based economically, where the headquarters are. That is decisive for us. If the state where the headquarters are decides to accept this company as a juridical person, then we take over that idea. If the state where the headquarters are does not know or does not accept this legal type, then we say no. For example, in our case, which I brought forward to you, if you only have business activities and have the headquarters within Germany, then Germany would be competent under the German theory for the decision if that can be accepted as a juridical person or not. And Germany would then just look through and say a Far-Awayistani legal form does not exist in German law, so we do not accept this. On the other hand, if the headquarters were in Far-Awaystan, then we would say headquarters are in Far-Awaystan, so Far-Awaystan is the state who shall decide if that should be a juridical person or not. We look into what Far-Awaystan does, and if we find out, okay, Far-Awaystan says this legal form is a juridical person, we would accept this. This is just a theory to avoid abuse, so that somebody tries to get around the binding rules of his own home country and tries to establish juridical persons under a foreign, more convenient rule. Good. Yeah. Within the EU, by the way, the legal situation is a bit different. EU law has harmonized company law, and there is a rule which says a foreign person having the citizenship of another EU state may never be discriminated in comparison to a person of your own country. And the European Court of Justice said, well, if you have to give equal rights to a French person as German state, you cannot say we give equal right to French persons, but we decide who should be French and not. They say who is French is decided by the French state. So if you have the French citizenship as a natural person, we cannot say you should not be French. We have to give you equal treatment. And they said with legal persons, this is exactly the same. If the French say this is a corporation existing under French law, the Germans can't come and say, yeah, we should give it equal treatment because it's a French corporation, but we think the French did it wrong, and under our perspective, this French corporation should not exist. So the ECJ said, the European Court of Justice said, if there is a juridical person accepted or established under the law of a state of the EU, then its existence has to be acknowledged. By the way, what is very often not seen in the debate is there are even directives of the EU, so binding orders to all member states, which say juridical persons come into existence when they are registered. And then there is a nice additional sentence somewhere in that directive which says, as long as they are registered, nobody can bring forward that they should not exist. Legally, such a juridical person exists under the company law of the EU. And so within the EU, we have to accept that everything which has been registered in one EU state is really existing. So only with non-EU states we still have the right to test if the existence of that company is perhaps from our perspective abusive, and if it should have been registered under German law, fulfilling the conditions of German law, like in my Far-Awaystani example. Good. Naturally, I told you again, a partnership is defined as several persons who associate themselves to follow a common aim. That's nearly the common understanding of the most states. I cited here a Wikipedia definition, and this is sometimes nice to get a first impression. But ladies and gentlemen, naturally, when it comes to writing academic papers or so, then one of the rules is naturally always try to get high quality sources, expert sources. And so naturally, there you would probably not use Wikipedia, because we can agree that probably experts do know better sources than Wikipedia. This is not the most high-level source available, so you should refrain from using it in official papers. Good. For income taxation, I already told you that a partnership means several persons act together, they own income together, everybody of them owns then a share in that income. And so the logical consequence is everybody has to pay income for its own share of the income. That is what many states see this way. There might also be a different approach. There are some states who treat partnerships as if they were juridical persons. That is then usually done for simplification reasons. The technical term for that is sometimes that if you see a partnership as a partnership and then tax every partner with his own share, then you see through the partnership on the partners. And so that is called, the partnership is treated as a transparent entity. Transparent is, for example, glass, things where you can look through. So a partnership is treated as transparent, means you look through the partnership to the partners being behind the partnership, and they are the persons to whom you attribute the income, and they are the persons whom you tax for the income. Whereas the minority view, those states who treat partnerships like corporations, they would treat a partnership as a non-transparent entity. So where you see the partnership and don't look through to the level of the partners, but then would say the partnership is different from the partners, and we do as if it were a corporation. So we tax it with corporation tax. Both things exist in the world naturally. The German approach, so the transparent treatment of a partnership, ends up with each partner is taxed separately with his own share. But as I already told you some videos ago, for reasons of simplification, it makes no sense that if you have a partnership of 100 partners, that the profit of the partnership is calculated by each of the 100 partners separately, that all this has to be checked. And so the most convenient and simple way is that you once and for all establish how much profit that partnership had, check it, and then communicate to each partner how much his 1%, 2%, or 50% share in that partnership means for him or her. That is called a separate assessment because the profit of the partnership is determined separately from the rest of the income. And it's also called a uniform assessment because the calculation of the profit is done in the same way for all of the partners. So it's a uniform assessment. There can be no differences. And so this is called, under German law, a separate and uniform assessment. Also here, well, you cannot rely that it's done in the same way everywhere automatically. But you see, the problem will be there everywhere. When you have a partnership, or if you have a partnership of, let's say, 100 partners, determining that profit for each partner individually would create a chaos, contradictory results, and especially it would multiply the necessary work. So you can probably expect that also other countries have special rules for the determination of the profit of a partnership. In detail, they might be different. That's clear. Good. Yeah. Now, sometimes the problem is that if you read something about somebody is involved in a foreign entity, then you must find out if that foreign entity is a juridical person or a kind of a partnership. And now, surprise, it might come that you go to another state and ask the people, is your entity here a juridical person? And then this person from a completely different culture asks you back, what do you mean by the term juridical person? We do not strictly know that. and you say, you have no juridical persons, tell me. And perhaps you get an outline of what they have, and then you think, oh, that sounds pretty much the same as if it were a juridical person. Then the guy or girl tells you, but we don't treat it as a person. We don't say it's a person. So the question is then, is that a difference? So what to bring near to you is the idea that naturally every culture in the world is independent. They have their own traditions. It might be that they have similar phenomena, but it might be that they are not completely identical to what we would treat as a true person. So there might even be entities where the rules are a kind of a mixture. And so in the end, you would have to decide under which category the foreign entity can be categorized the best. So to which type it resembles the most. So you will have to compare the rules for the foreign entity with the two types of, is it more like a partnership or is it more like a juridical person? There will be arguments in the sense of pro and con, and you will have to see what overweighs. So if the foreign entity resembles more closely to a corporation or to a partnership. In the EU, by the way, that's often more simple, because we have that rule: if an EU state establishes something and calls it a juridical person, so if it has the full rights of a person, then you have to stick to that qualification of that foundation state. On the other hand, it might be that other EU states could perhaps have some legal forms in between, and so then you would still have to think to find out, is that status which they give to that entity closer to a juridical person or not. Okay. So you see already the distinction, if something is a juridical person or not, can end up in a scientific research and in enormous complexities. But in everyday life, when it comes to the most frequent legal forms, then everybody knows for sure if something is a juridical person or not. So nobody will ever dispute if a corporation under US law is a juridical person or not. We just know it is. Nobody will ever debate the legal character of an English limited, and so on. Good. Now we have different persons, and now we have also different kinds of tax liability, because there are persons who are taxed on the basis of their worldwide income, and there are persons whom you only tax with the income from your own state. Now, which ones are which ones? There's a simple principle. When the person lives in your own state, then you can catch the person and force it to pay on everything. So the worldwide income taxation is usually done with the people living in your own state. You can force them to declare everything and to pay on everything. Sometimes one needs some technical terms for that, naturally. In English-speaking countries, we would speak about the resident taxation, the taxation of residents, so of people who live there. One would speak of the universality principle, because everywhere where your income comes from, all is relevant. One would also speak of comprehensive worldwide income taxation, or comprehensive taxation of the income. In Germany, one would talk of unlimited tax liability. This is a bit of an unhappy term, because if you hear something about unlimited taxation, you always think, oh, 200% or 500%, or there's no limit to taxation. What stands behind that term in Germany is the idea that taxation is not limited to the inland income. There is no geographical limit to the tax claim. That's unlimited tax. And my recommendation would be always speak of unlimited tax liability. Don't speak of unlimited taxation. That creates the wrong associations. Already unlimited tax liability sounds strange and sounds brutal to others because they all think of the rate, which might be unlimited. It is not. The only thing is the tax claim is not limited to the inland. Now, why don't we take over for our purposes the expression resident taxation, so as the English-speaking countries? And the answer is simple. I wanted to remain as close as possible to the German terminology. And the second thing is, if I now speak of unlimited tax liability somewhere, you directly know in which movie you are, that you now are talking about German law. If we used the same terms for every different nation, then the problem would be you would probably mix it all up. Now, if we decide to use different terms, then you know things where we speak about unlimited tax liability have to do with German law. If we speak about the taxation of residents and non-residents, we speak about the situation in England or the USA. So different terms are a bit difficult in the beginning, but later they are a great help because you can directly, by the choice of the terms, signal to the other person to whom you speak about what you are speaking. Good. Now, if you have persons living abroad, you can't get hold of them, and so the only thing which you can really bring into your possession is the things which they earn on your own territory. In line with that, usually a state taxes only the income from its own territory when that income goes to persons living abroad. In that case, your tax claim is limited to what happens in the inland, and that is the reason for the German term limited tax liability. So that is not, again, not meant with direction to the tax rates or the amount of the tax. It's just signaling that the tax claims are limited to the things which happen in the inland or which have a close connection to the inland. Here, the underlying principle is not called the universality principle because not everything happening everywhere is relevant anymore, but it's the territoriality principle, so that the state taxes the things which have to do with its own territory. So this is the most interesting distinction. Now, why do we have these two types? Well, the first thing is perhaps international law. Not here on this slide, it's going to come later. International law says a state can only apply its laws to things which have a connection to that state. That connection can either exist by the person involved or by the event involved. Now, if the person has a connection with my state, everything connected with that person is connected with my state, so I can, under international law, oblige that person to follow my laws for everything that person does all over the world, so I can claim income tax from all that person does all over the world. And naturally, if I can, I do. On the other hand, international law says if a person has no relation to my country, then I can only subject that person to the things, to my laws with regard to the events which have a connection to my territory. If the person is not connected to my state, I can only subject things to my state laws, which happen within my state. That's a general principle. So if somebody in China takes a taxi to travel from Beijing to Hong Kong, the Chinese person has no connection with Germany, and the things done have no connection with Germany, so Germany is not allowed to apply any of its laws to that event done by that person. Immediately when the person or the event has a connection to Germany, then the laws could apply. And so if a person lives abroad, no connection of the person, so we can only subject the events to German legislation which have to do with Germany, and that is, when it comes to income, only that income which comes from Germany. So that is the rule or the reason from international law. So limited and unlimited taxation just follow from the general principle: no state is allowed to apply its laws to something which has absolutely no connection, neither by person nor by event, to that state's territory. Good. Now there are also economic reasons. The first economic reason is if you have a person in your state living there, and you only tax that person with income from the state, but not from other states, what will be the effect? Well, if a German has 100,000 euro to invest, and you tell that German, if you invest it in the inland, you have to pay 40,000 or 40% taxes. If you invest it beyond the border, you pay nothing. What will happen? The answer is clear and simple. Everybody will shift everything they can beyond the border to profit from not being taxed. So what does that mean? If you renounce on a worldwide income taxation, you give a strong incentive to your people to shift everything abroad and to ruin your own economy. You produce a capital flight. You produce shifting jobs abroad because all your people want to live in your country but want to earn their money elsewhere, and so on. So it's highly counterproductive to renounce on worldwide income taxation. You are nearly forced to have worldwide income taxation because immediately when something can be earned for a lower tax rate abroad, your people will feel the motivation to shift their activities abroad. So economic reason number one is renouncing on unlimited taxation for your people in your country ruins your own economy. Limited tax liability. Why is there also a compelling economic reason for that? Imagine you have no limited tax liability, but you want also to apply a worldwide taxation on the foreigners. Now imagine there is a billionaire living somewhere in Saudi Arabia, and that billionaire thinks about an investment project in Germany, which could bring 1 million of profit. But if that then triggered a worldwide income taxation for that millionaire, that person would probably say, okay, I could earn 1 million more than I have in Germany from an investment, and the result would be a tax claim on my whole worldwide income, and perhaps that tax claim would amount to 60 million or so. That's evidently rubbish. You would keep all foreign investors out of your country, so that would be detrimental to your economy. So you can't do that. The only alternative is either you tax only the inland income or you even renounce on that. Now, why will you be forced to tax the inland income of the foreigners? Imagine you have a few houses in Germany, and when you live here, you have to pay taxes on it. Now, when you move beyond the border, your rent from Germany would then be not covered by limited tax liability. If that were the case, what would you do? I don't know what you would do. I would move. Because if leaving the own country would just mean getting rid of all the tax claims of my income from Germany, that would give me a strong incentive to leave the country. And you can probably understand no tax legislator wants to design tax laws in a way that every tax advisor says to all persons who have enough money, leave the country. It's the only way to get away with a decent net income. So you can't do this. And the other thing also, which you must look on, is what would happen if you own a house in Germany and have to pay taxes on the rent income, and foreigners, if they buy a house in Germany, don't have to pay taxes on the income. Then the foreigners would be able to bid higher prices for German houses, because for them the revenue from these houses would be higher, so they could finance higher bank credits and they could afford to bid higher prices. So after a generation or so, nearly all your houses would be owned by people living abroad. Also, that cannot be an aim of your policy. The same applies with firms. So you have also compelling economic reasons to have a limited tax liability for the inland income which foreigners achieve in your country. It might, at least everywhere where such a risk of distortion of economy exists, especially distortion of competition, there you are forced by economic reasons to have a limited tax claim. International law, I mentioned that already. So we have two compelling reasons at least behind the present tax system, which usually distinguish between an unlimited tax claim and a limited one. I once found a list of an overview about the tax system, over the tax systems of the world. That was somewhere in the English Wikipedia, and they listed 207 territories on the earth with an independent tax system. That was probably not complete, but if you really have the English version of Wikipedia, it can be that probably many people from many states contributed to that, and if somebody saw that his state or territory was missing, they will probably add it to the list. So it's probably nearly comprehensive and nearly complete. And 90% or more of these territories and states had a worldwide income taxation. There you see how compelling such a system is. And only a very few states with a very unimportant economy where the risks which I outlined probably do not even exist. Only these could afford to renounce on a worldwide income taxation. So that basic structure which we outlined for the personal tax liability seems really to be the same everywhere. Sometimes you have compromises. For example, at least in former times, the UK law knew something which was a worldwide tax liability, but only on the so-called remittance basis. So it could be that your worldwide, a part of your worldwide income was ignored as long as you didn't transfer it home. These are rather historical exceptions. In principle, you will have strong tendencies to worldwide income. The general rule when you test the nature of tax liability is that limited tax liability is only something which comes into the question when every possibility to apply unlimited tax liability has failed. So the first thing you always have to test is a person unlimited tax liable in that country? If so, matter is closed. Only if that's not possible, then you can go forward and test if there is a limited tax liability. Here I have a short translation of the German Income Tax Act in section 1.1. So at the beginning of the law, as the first step, you have a description who is covered by unlimited tax liability. Natural persons, you remember the German Income Tax Act, the ESTG Einkommensteuergesetz, is only applicable for the natural persons. The other ones are corporation tax subjects. Natural persons who have a residence in the inland or their habitual abode in the inland are subject to unlimited tax liability. So you see clear conditions. You must be a natural person and you must either have a residence or a habitual abode. Now, what's a residence? A residence is something which you have where you have rooms or a home which you intend to use and to keep. So a house or rooms where you live. Now, there might be people who don't have a constant residence. For example, you live in hotels only, or surprise, you live in prison. A prison cell is, ladies and gentlemen, that is something where we can agree on, probably not a home which you intend to keep and to use. Your intention would be to leave it as quick as you can and to forget it as quick as you can. So living in a prison cell would be an excellent way to avoid having a residence in the inland and to avoid worldwide taxation. That can't be. So you have a supplementary criterion, a subsidiary criterion, which is tested. If you have no residence in the inland, then they ask you if you usually stay in the inland. So that's nicely put, the habitual abode. So if you don't have a home in the inland, don't have a residence, but usually are in the inland, perhaps move from hotel to hotel or stay in each city only 2 days, then you don't have a permanent residence here, but you usually are in the inland, you usually are in Germany, and that would be a habitual abode. In that case where you have this, you would be subjected to unlimited tax liability. By the way, if we go with common sense, use our common sense and look to the sentence, it's clear why a legislator who is a bit wise must express or must take these criteria. If you only look to the residence, then people would have a strong incentive to burn down their homes and to live in a tent in the garden, or just to go and live in a hotel permanently, changing the rooms from time to time so that nobody can say they have a permanent home somewhere. If you don't want your rich people to live in hotels, burn down their houses, and sleep under bridges just to avoid taxation, then you should add the additional criterion of the habitual abode. It is sufficient that you live in the inland, even if you do it outside an own residence. Good. That is then unlimited tax liability. After some paragraphs more, at the end you find paragraph 1, section 4. Natural persons who in the inland neither have a residence nor their habitual abode are subjected to limited tax liability if other special rules do not apply. Now here you see a nice formalistic element. They are only subjected to limited tax liability if they have income which could be taxable as inland income. So a Chinese living in China and doing things only in China would not be labeled as limited tax liable person in Germany and not be obliged to hand in a tax return stating I had no income from Germany. You are only called limited tax liability taxpayer if you have at least obtained €1 of taxable inland revenue. That's just a formal aspect. So you can always say if you are not subjected to unlimited tax liability, then that person has to be tested according to the rules of limited tax liability. That's clear and simple. Good. For the corporations, the same is laid down in section 1 of the corporation tax in paragraph 1, or paragraph 1, section 1 would be rather more the German way to cite it. Subject or subjected to unlimited tax liability are the following corporations, associations of persons or properties. That is a kind of way to say juridical persons and entities which are treated like juridical persons. If they have their place of management or their statutory seat, so registered office, in the inland. The statutory seat is the place where you have your official address. And in the region where you have your official address, that is the region where the authorities decide if you are to be treated as a juridical person or not. So where you are registered, there the authorities apply their local company law or laws on juridical person and decide if they turn you into a juridical person or not. So if you have registered office as Cologne, there an authority in Cologne will register you, and there you get the status of a GmbH or AG. So that means if you are registered in the inland, you are automatically an unlimited tax liability taxpayer. Now, if your legal form is a legal form of another state, so you are registered in Ireland, Netherlands, or where else, then it is sufficient to have your place of management in Germany, so your headquarters. And then they list everything which is possible. The different juridical forms a comprehensive list, and if you are on that list, you will be taxed with your worldwide income as a juridical person. To clarify this, that they need to pay tax on the worldwide income, you have here section 1, paragraph 2, KStG, Körperschaftssteuergesetz, Corporation Tax Act, which says unlimited tax liability extends to all income, to your worldwide income. That's meant. Paragraph 2, 1 KStG then says again, if you are not subjected to unlimited tax liability, your income situation has to be tested according to the rules of limited tax liability. So it lists up which cases are possible here. That's mainly if neither your place of management nor their statutory seat is in the inland. So if you are not subjected to unlimited tax liability, sure. Good. And let us have a glance on the consequences of unlimited tax liability and limited one. If you are subject to unlimited tax liability, there is applied to your situation a catalog of 7 types of income in Germany again. Other states have other catalogs, you know. Here's the list. Begins with agriculture and forestry, because in the times when that catalog was written, 1890s approximately, agriculture and forestry still was the most important income type in Germany. And then came business, certain self-employed business people that are rather only the so-called free professions, so special type of businesses, wage income, income from capital investments, income from lease and rent, mostly from houses or from license fees from rights, and some specific other income events listed in a special paragraph. Now, if you are only subjected to the limited type of income, then they must further determine which income is so closely connected to the inland that it can be regarded and taxed as German inland income. So here in section 2, you saw that here there is just the list income from agriculture, and they don't bother to say where that agricultural activity must have been, because there you have a worldwide tax claim. So wherever you do this plays no role at all. If you look to section 49, the catalog of taxable income for the limited tax liability, there they also have to say when something has come from the inland, and sometimes they have to decide under which circumstances the connection to the inland is close enough to justify taxation. For example, income from business is only inland income if the foreign business person has a permanent establishment in the inland. A permanent establishment is an institution or a device or rooms which are permanently kept in the inland and serve your business. So if you just send goods from China or from England or from the USA by mail to Germany, that would not qualify as being connected strongly enough with the inland. That would be regarded as a foreign activity, even if you have German customers. Then there are some other special things, for example, sports events or entertainment events in the inland justify inland taxation. Self-employment, if you exercise your activity in the inland or if you have an inland bureau. Dependent work, if your work is done in the inland or the results of your work are used in the inland. Income from capital, if you invest capital in the inland and get interest on dividends. Lease and rent, if the property rented to others is in the inland, and so on. So here you have a slightly different list of income. The Corporation Tax Act takes over the same catalogs just by a general clause. In paragraph 8.1 KSDG, you find the general nice rule which says what has to be regarded as income and how that income has to be calculated is to be determined according to the rules of the Income Tax Act and of this tax act. So if the Corporation Tax Act contains a modification of the general rules in the Income Tax Act, that prevails for the corporation. Or if additional problems have to be regulated by the KSDG, then naturally that has also to be followed. Good. When it comes to testing the personal tax liability, you must then test if something is unlimited or limited tax liability, and for this you must be safe what regards the terms residence, habitual abode, statutory seat, and place of management. So residence is where you have a habitation at your disposal under circumstances which allow the conclusion that you are willing to keep that habitation and use it. So if you rent rooms for an unrestricted period of time, that is evidently establishing a residence at a certain place. If you make a rental contract for 3 years, that would also mean you establish a habitation which you can use, and you want to keep it for a longer time. You know, nothing is for eternity. And so to keep that habitation means to keep it for a longer period of time. That is not defined in the law. The courts in Germany say if you want to keep rooms or habitation for less than 6 months, that's definitively not with the intention to keep it for a longer time, because then you directly have in mind that after a short time you will again have to leave there. But if it's for longer than 6 months, then that is already a certain duration which justifies the conclusion that that will be kept over a longer time. So if you want to test this in individual cases, and you must always test it if it's really fulfilled, because there your whole nature of taxation relies on, then you can always test these definitions. Does somebody have a residence in a cell in jail? And the answer is no, you don't have a cell in jail at your disposal and you don't want to keep it. So two reasons why you can't speak of a residence. You visit a friend and live there for 2 months. It's not your own room, you are a guest and you cannot intend to keep these rooms, so no residence there. A child lives in the rooms of his parents, and the answer is yes, the habitation is also so. The room, the home, is also the own home of the child, because that child who lives there can regard this as where I, the child, live, and will keep that for a longer while. You are a captain on a board of the ship, and you live there and sleep in a cabin when the ship is on the high sea. A cabin in a ship is not a habitation. It's not rooms which you want to keep. You have the cabin at your disposal, but it's not sufficient to see that as a habitation, as rooms or a home. You can't say my home is my cabin on the ship. Habitual abode is defined as you have this where you stay under circumstances which allow the conclusion that you do not only stay there temporarily. That's a general clause, and to simplify the discussion, then there is a legal fiction directly in the next sentence. As a habitual abode always is regarded any continuous stay of more than 6 months in the inland. Now, if you leave for 2 days in order to visit Disneyland per Paris, that is not terminating your continuous stay, because also with an inland person who goes for 2 days for Disneyland Paris, the neighbors would not say that person does not live anymore here, that person went to Disneyland. So a short break doesn't terminate the 6 months, it's simply ignored. So if one weekend you go abroad on a visit, that does not count, as long as you stay continuously for the same reason in the inland. If you are more than 6 months here, that's a habitual abode. Now, many cases which we have mentioned before would probably end up in the habitual abode if we have no residence here. For example, the cabin on a ship. If it's a German ship, it was not a residence because it's not your home, but a German ship is German territory, and so you stay on German territory if you are the captain, perhaps for more than 6 months. So that would be a habitual abode in Germany. If you live in a prison cell, this is not your home, but living in a prison cell with a sentence for murder, for example, justifies the conclusion that you stay there under circumstances which allow the conclusion that you do not only temporarily stay there. Yes. Imagine you are a flight passenger, you have a landing in Frankfurt Airport, and there you get into a quarrel with somebody else. Unfortunately, you have a knife in your possession or a Colt, and you shoot the other person down. Then from that moment onwards, we can justify the conclusion that you stay now at Frankfurt Airport or at Frankfurt under circumstances which allow the conclusion that you do not only stay there temporarily. So that would be, under tax aspects, highly unfavorable to shoot persons at Frankfurt Airport, because it leads to a habitual abode and so forth, to unlimited tax liability in Germany. The 6 months is replaced by 12 months if your stay in Germany has nothing to do with business purposes, but only for private purposes. So you lie in a hospital, you are on holiday here or so, then you have 12 months free. Naturally, again, the basic idea will be found in many other states too, but such arbitrary time limits like 6 months or 12 months, that is probably different in other states. So there you should inform yourself what will be the situation there. The same, by the way, with the residence. The idea that you only have a home where you want to keep it for more than 6 months, that's rather arbitrary. So it might be that you have a home under the perspective of a foreign country if you stay there for 3 months or only for 3 years or so. That can be decided differently by every state. Here it is interesting, as always, to read the law as it is written. So to take a glance at the exact wording. Imagine you are a student, you come to Germany, you rent a room. Then you leave that room, cross the road, and then you are run over by a bus and die. Did you have a residence in Germany or a habitual abode? And the answer is, did you have a residence at your disposal which you wanted to keep and use it? Yes, you rented a room. The intention was to keep it for more than 6 months, so for a longer while. Nobody could foresee that you would die in the afternoon. So you had established a residence, so when you died, you were subjected to unlimited tax liability. You had a residence and wanted to keep it. So you either end up with a residence or with the habitual abode. Most cases will be decided already by the residence, because most people living here for a longer time will rent rooms or buy a house. But the habitual abode is necessary to avoid fishy cases, or to tax extraordinary cases in the right way. For example, there is a famous singer who has no house of his own in Germany, but permanently lives in a hotel in Hamburg. And if you only own a hotel suite, which you rent from time to time, and which you use when you are in Hamburg and don't pay for the moment when you're not there, this is simply a stay in the inland, and this stay is also for more than 6 months. If you leave the inland in the meantime for 3 or 4 days, nobody would then think that this person does no longer live in Hamburg in that hotel. So short gaps are ignored. Also cases like a foreigner lives in a hotel in Cologne for 4 months and then moves on to a hotel in Munich for 3 months. So you don't have a residence in the hotel because you didn't keep rooms for a longer time, which you wanted to keep permanently, or with a certain permanence. 4 months is not enough. But what you can say there, no residence in Cologne and no residence in Munich, but more than 6 months continuously spent in Germany triggers a habitual abode, so that person is also subjected to unlimited tax liability. We have already discussed these things. Even tragic accidents can lead to a habitual abode. You come to Frankfurt, you leave the plane there for a connecting flight, you wait for a small amount of minutes, you slip on a banana, break your skull, go to hospital and lie there in coma for 7 months or for 2 years. In that hospital, naturally, you don't have a residence. But the question is now, do you have a habitual abode? And it's clear, you stay in Germany for more than 6 months, let's go back to section 9 and read it. Section 9 AO, so General Tax Code, Abgabenordnung, says, as a habitual abode within Germany is always seen a continuous stay of more than 6 months. You lie in hospital in coma for more than 6 months, 7 months. So that would apply, but fortunately you are saved by sentence 3. Sentence 2 is not applicable if your stay has entirely private motives, and if you lie in coma, this is a pretty guarantee that you don't do business in the time. So the time limit is extended to 12 months. You lay in hospital only for 7 months, so you are safe. You don't have an habitual abode in Germany and you don't have a residence, so you are only taxed under the rules of limited tax liability, if at all. Now, if that is a hospital stay for 2 years, then the time limit for entirely private stays in Germany is 12 months, as we have seen just now. And as you see, 2 years in hospital, that's far more than allowed. So you have a habitual abode in that hospital, so you are subject to unlimited tax liability. Now you will probably say, but I never intended to go to Germany. I just ended up there by accident, by coincidence. That can't trigger a tax. And then your tax inspector says, well, what I have to apply is the law and not my private opinion. And the law says habitual abode has someone in Germany if that person is there for more than 12 months. The law does not speak about your intentions, so that's not relevant. There is a clear condition. Did you stay for more than 12 months for entirely private reasons in Germany? And the answer is yes. And nobody asks for the motives. So you have a habitual abode. So you are subjected to unlimited tax liability. And if you now think, it can't be fair, then the tax officer will ask you or will tell you, well, when I was born in Germany as a German, nobody ever asked me before if I wanted to. So it's natural that if you end up in a country, probably you didn't choose it. That can't be a criterion. The law doesn't speak about that criterion. We already took special regard to the situation where somebody didn't come to do business. That was that extended period of time which you can stay here for 12 months. You stayed here for 2 years, so your problem. You fulfilled the conditions of the law, and I'm not going to debate about the law, so you will be subjected to unlimited tax liability. Sorry, there is no debate about that. So here we have it. Again, sorry. So, juridical persons. The seat of a juridical person can be freely chosen where you want to be registered. That counts for taxation. There will never be any debate if the seat has been abusive or not. Where you are registered, that is the seat for tax purposes. So if you choose a registered office address in Germany, that triggers unlimited tax liability. If you don't, then that does not trigger unlimited tax liability. But if you then have a place of management in Germany, then that is sufficient to trigger unlimited tax liability too. So this is clarified by the AO again, because it's an important criterion. Paragraph 11 AO says a corporation, etc., has the statutory seat at the place that is determined by law, the statutes, the foundation documents, or similar rules. So that is a merely formal and arbitrary criterion. By the way, the seat must always be in the country which gives you the status of a juridical person. So you will never be able to establish a Dutch BV with a registered office or a statutory seat at Kleve, because if the statutory seat at Kleve is chosen, so Germany, then you have to go to a German authority responsible for deciding about juridical persons at Kleve, and the German authority will not apply Dutch law to create a juridical person. They will apply German law to establish a juridical person. So the possible legal form would only be a GmbH and not a BV. Nice question. Is it possible that a GmbH might have a seat outside Germany? In principle, if it is a German GmbH, not. But, surprise, there is also another German-speaking country in the EU. That's Austria, and they also know the form of Gesellschaft mit beschränkter Haftung. And the Austrians are nice. They usually choose a slightly different abbreviation. GES MBH instead of GmbH, so to signalize to others that this is not a German GmbH, but it can be that Austrian firms also use the GmbH abbreviation. In that case, you must look where they have their statutory seat. By the way, the same is possible with limited companies. They can be Irish, so within EU, or they can be English, so outside EU. Okay. NV is a Dutch form, naamlose vennootschap. That's the Dutch parallel to AG, so to stock corporation. And this would have the seat either in the Netherlands or in Belgium, because also Belgium uses in a part of the country Dutch as the official language. SE can have the seat everywhere in Europe. Good. Very important for international tax law is the place of management. That is that place where the major decisions of everyday management are made. So every juridical person has a set of decisions which can be made by its management. Even if you are only a subsidiary in a group of companies, you still have to decide certain matters on your own, and where these decisions are taken, there is the place of management. The place of management can be everywhere, because there might be company law restrictions on where it should be, but the law doesn't ask where it should be. The tax law here clearly defines where it is done, that the decisions are taken. And so reality is the only thing which counts. The first thing what a tax inspector wants to find out during a tax audit, if they suspect or if they want to subject you with a foreign legal entity to German unlimited tax liability, is they want to find out if the major decisions of everyday management have been taken on German territory. For example, if the foreign manager of the foreign company was always obliged to give you a telephone call and ask for your decisions for the management strategy, because then the major decisions of everyday management were taken not by the manager in the foreign country, but by you on the other end of the telephone line, and that would lead to a place of management in Germany and unlimited tax liability. I have here in the slides, which perhaps you have a look on at home, several examples. Naturally, the question is, can the place of management be at a different place from the seat? And the answer is yes, naturally yes, otherwise it would make no sense. But it depends on the company law of this state and other states. There are states who do not allow their companies to have the headquarters, so the place of management, at a different place from the registered office or from the statutory seat, which are two words for the same. And there are other states like England or nowadays Germany for some legal forms which allow that the place of management can at a different place from the statutory seat. So that's a matter which every state can decide for its own legal forms in its company law. If you have to do with the so-called Societas Europaea, so European society, there you should know that European society is one of the legal forms where the statutory seat has always to be at the same place than the place of management. So if an SE has a seat at Kleve, that automatically means the place of management will also be there. Whereas with the German GmbH, that can be registered at Kleve and can then establish a place of management at Barcelona in Spain or at Madrid in Spain or in South Africa. That's possible since some years ago.